Most traders don't blow up because they picked the wrong stock or missed a key technical signal. They blow up because they never understood one brutal mathematical truth that operates silently in the background of every trade. If you risk 10% per trade, you're only 10 losses away from ruin. Let that sink in. 10 ordinary losing trades. One bad week. And your trading career is finished. Not because you're stupid, not because you lack discipline, but because the mathematics of drawdowns are asymmetric and unforgiving, and most traders never bother to run the numbers until it's too late. Here's the identity shift you must make today. Amateurs obsess over strategy and entries. Professionals obsess over risk per trade and survival mathematics. An amateur looks at a setup and asks, how much can I make? A professional looks at the same setup and asks, how much can I lose, and can I survive being wrong 20 times in a row? That question changes everything. It transforms trading from gambling into a probability game you can actually win over time. Amateurs think in terms of what they hope will happen. Professionals think in terms of what can happen, and they build their entire process around surviving it. They know that even the best systems, with positive expectancy, produce strings of losses. Jesse Livermore had them. Paul Tudor Jones had them. Every professional who's ever traded has experienced stretches where nothing works, and the market seems designed to punish every decision. Picture two traders, both starting with $10,000. Trader A risks 10% per trade because he's confident in his system. He's back-tested it. He's seen it work. He believes in his edge. Trader B risks 1% per trade because she understands asymmetric mathematics. She knows that survival comes first, profits come second. They both hit an inevitable losing streak, 6 trades in a row. Nothing catastrophic, no black swan event. Just a period where their edge doesn't pay out immediately. Let's walk through the brutal math. Trader A starts with $10,000. First loss at 10% takes him to $9,000. Second loss at 10% of his remaining equity drops him to $8,100. Third loss brings him to $7,290. Fourth loss cuts him to $6,561. Fifth loss drops him to $5,905. Sixth consecutive loss leaves him at $5,314. He's lost nearly half his account. His confidence is shattered. His psychology is in ruins. He's now in the nightmare zone where every trade feels like life or death because he's fighting just to get back to break even. Trader B faces the same 6 losses. She starts at $10,000. First loss at 1% takes her to $9,900. Second loss drops her to $9,801. Third brings her to $9,702. Fourth takes her to $9,604. Fifth cuts her to $9,508. Sixth loss leaves her at $9,415. Same market, same entries, same system. The only difference? Position sizing. But here's where it gets exponentially worse for Trader A. To recover from a 50% loss, he doesn't need a 50% gain, he needs a 100% return just to break even. That's the asymmetric mathematics of drawdowns working against him. If you lose 50% of your capital, you now have half of what you started with. To get back to your original amount, that remaining half must double. The formula that governs this nightmare is brutal. Required recovery equals loss percentage divided by 1 minus loss percentage. So a 50% loss means 0.5 divided by 0.5, which equals 1, or 100% required gain. A 60% loss requires 150% to recover. A 70% loss demands 233%. The deeper the hole, the more impossible the climb becomes. Trader B needs just a 6.2% gain to reach break-even. More importantly, her psychology remains intact. She's not desperate. She's not revenge trading. She's not widening stops to avoid admitting she was wrong. She can continue executing her system with the same calm discipline she had on day one, because she's still playing the infinite game. Trader A is now playing a finite game, fighting for survival. When you're down 50%, you don't trade logically anymore. You trade out of desperation. You start looking for home runs. You take setups that aren't there because you feel the pressure of that massive hole. You're trading with fear, and the market punishes fear mercilessly. The 1% risk rule is simple. Never risk more than 1% of your total account on any single trade. Not 1% of your position size, 1% of your entire account if the stop loss is hit. This distinction is critical. If you have $10,000 and you buy $1,000 worth of stock, that's 10% position size. But if your stop loss is only 2% below your entry, you're risking $20, or 0.2% of your account. That's acceptable. The position size doesn't matter. The dollar risk if you're wrong is what matters. This isn't conservative trading. This is survival mathematics that keeps you in the infinite game. You're not giving up potential profits for safety. You're maximizing long-term profit potential by ensuring you never take damage that's mathematically difficult to recover from. Think of it this way. You're becoming the casino. The casino doesn't care if it loses a single hand of blackjack. It doesn't panic when a player wins big. Why? Because the casino knows the math is on its side. They limit their risk on any single bet so that no single player can bankrupt the house. They play the long game. If you risk 1% per trade and you have a genuine edge, even a small one, you can lose 30, 40, even 50 times in a row and still have capital to continue trading. You'll never face a scenario where one bad week ends your career. But if you risk 10% per trade, you're always just a few losses away from catastrophic damage. Your first job as a trader is not to make money. Your first job is to avoid blowing up. Money comes from consistency. Consistency comes from survival. Survival comes from obeying the math. In this video, we'll break down the exact protocols professionals use, how to calculate position size based on stop distance, how to manage correlation risk when multiple positions secretly become one dangerous theme, and how this supposedly defensive rule actually accelerates wealth building through compounding. But first, you need to see how even a winning system becomes a wealth destroyer without proper risk management. Because here's what nobody tells you. You can have a profitable strategy, a real edge, and still go broke if your position sizing is wrong. And that's exactly what we're going to explore next. Let me show you the most dangerous trader in the market, the one with a genuinely profitable system who doesn't understand position sizing. This trader is more dangerous than the complete amateur because the amateur knows he doesn't know. The amateur blows up quickly, learns a hard lesson, and either quits or gets serious about the craft. But the trader with a real edge and poor risk management, he has just enough success to become reckless. He's tasted winning, seen his account grow, and that taste of success becomes the poison that eventually destroys him. This is the trader who will blow up and then say, "But my strategy works. I've proven it. I just had some bad luck." No. What he had was catastrophic position sizing that turned a statistical inevitability into account destruction. Here's a scenario that plays out in real accounts every single day. A trader spends months developing something genuine. He backtests rigorously, paper trades successfully, and builds a system with a 55% win rate and 2-to-1 reward to risk ratio. On paper, this is exactly what Jesse Livermore hunted for. Clear pivotal points where the tape shows direction, defined stop losses where the trade thesis is invalidated, and room to pyramid when price confirms in his favor. Mathematically, this system is a wealth-building machine. Run it over 1,000 trades with proper position sizing, and you become rich. But markets aren't traded on paper. They're traded with real money and human psychology. Our trader starts with $5,000. He's confident because he's done the work. This isn't gambling. He has a genuine edge. But he makes one fatal decision at the foundation. He decides to risk 5% per trade. $250 each time his stop gets hit. 5% isn't that much, he tells himself. I've got a real edge here. I don't want to waste time with tiny positions. That sentence has burned more accounts than bad strategies ever will. The first week delivers exactly what he expected. He hits 3 winners in a row. Because his system pays 2-to-1 on risk, each winner brings substantial profits. Trade 1. Risk 250, make 500. Account jumps to 5,500. Trade 2. Risk 275, make 550. Account climbs to 6,050. Trade 3. Risk 300, make 600. His account reaches $6,650. In less than a week, he's up 33%. The backtest is lining up with reality. His confidence transforms into something more dangerous. euphoria. This is where the most lethal emotion in trading takes control. He looks at his account balance and thinks, see? I was right. I can handle more size. If I just scale up now, I'll accelerate this curve. The voice in his head whispers, you're playing with house money now. Time to press the advantage. So he does what most traders do after early success. He increases his risk per trade. 5% felt bold initially. Now it feels conservative. He decides to risk 8% per trade, approximately $530 each time he's wrong. He hasn't changed his system. The setups are identical. The edge hasn't disappeared. What changed is his exposure to the inevitable. Because here's what always comes next in trading. The market shifts. Volatility changes. Clean trends turn choppy. A few false breakouts appear where reliable patterns used to be. The tape gets messy. Then it hits him, a standard losing streak. Not a crash, not some black swan event, just 6 consecutive losses, which every system with a 55% win rate will experience periodically. Let's walk through the brutal mathematics. He starts this losing streak at $6,655, risking 8% per trade. Loss 1, 8% of $6,655 equals $532. Account drops to $6,123. Loss 2, 8% of $6,123 equals $490. Account falls to $5,633. Loss 3, 8% of $5,633 equals $451. Account slides to $5,182. Loss 4, 8% of $5,182 equals $415. Account drops to $4,767. Loss 5, 8% of $4,767 equals $381. Account falls to $4,386. Loss 6, 8% of $4,386 equals $351. Final account balance, $4,035. He started this losing streak at $6,655. 6 trades later, he's at $4,035. That's a 39% drawdown from his peak. Nothing about the market behavior was abnormal. Nothing about his win rate or reward-to-risk ratio was invalidated. His system didn't fail. His position sizing murdered his discipline. Here's where psychology destroys mathematics. When you lose 39% of your capital in 2 weeks, your brain shifts into survival mode. The amygdala hijacks rational thought. Logic shuts down. Fight-or-flight response takes over. To recover from a 39% loss, he doesn't need a 39% gain. He needs a 64% return just to reach his previous peak. That feels impossible when you're staring at a decimated account. The dream of financial freedom has been replaced by the nightmare of explaining to family why thousands of dollars vanished. So he does what desperate traders always do. He abandons his system precisely when he needs it most. He enters his next trade, and when price hits his stop loss, he doesn't sell. He widens the stop because he can't emotionally handle another loss. It has to turn around eventually, he tells himself. He's abandoned the pivotal point concept entirely. Now he's just hoping. When that doesn't work, and he takes an even larger loss with the widened stop, he does something worse. He doubles down. He increases size to 10%, then 12%, then 15% on setups that aren't even strong, trying to make back $3,000 in one miraculous home run. He's revenge trading now, trying to force the market to return what it took. The system that would have made him wealthy with proper risk management destroys him because his position sizing made disciplined execution impossible. Within another week, his account drops below $2,000. Game over. This is why professionals think differently. They don't ask, will my system have losing streaks? They ask, when my system hits its worst statistical run, and it will, can I survive it psychologically and financially? That question changes everything. Professionals assume losing clusters are inevitable. They don't pray that losses won't happen. They plan for them. They structure their risk so that when 6, 8, or even 10 losses arrive in sequence, it's financially survivable and psychologically tolerable. The 1% risk rule pre-prices these disasters. Let's replay the same scenario with proper position sizing. Same $5,000 starting account. Same 3 initial winners. Each win at 1% risk makes approximately $100. Account grows to about $5,300. Then the same 6-trade losing streak hits. Each loss costs roughly $53. After 6 consecutive losses, the account sits around $4,830. Is it fun? No. Nobody enjoys losing money. But is he panicked? No. Is he desperate? No. He's down about 9% from his peak, not 39%. He doesn't need a miracle to recover, just 2 or 3 good trades. More importantly, his psychological capital is intact. He can sleep at night. He can analyze charts the next morning with clear eyes. He can execute his next entry without hesitation, because he's not fighting for survival. The 1% rule transforms a career-ending catastrophe into a minor business expense. It turns financial ruin into a routine drawdown that every professional trader experiences regularly. But here's the challenge. Knowing this rule and implementing it when real money is moving are completely different skills. Most traders hear this explanation and nod along. They agree with the mathematics. They promise themselves they'll never risk more than 1%. Then the market opens. They see a setup that looks perfect. The chart is screaming direction. That rush of dopamine hits. They think, this is the one. This trade changes everything. And in that moment of emotional hijacking, they throw the rule out the window and load the boat. They confuse conviction with certainty. But there is no certainty in markets. There is only probability. And probability demands that you respect the risk of ruin on every single trade, regardless of how obvious the setup appears. You need more than knowledge. You need a mechanism. You need a hard mathematical formula that removes emotion from the equation entirely. In the next chapter, I'll give you that exact formula. We'll stop guessing. We'll stop sizing trades based on how we feel about them. I'll show you how to take your account balance, your entry price, and your stop loss, and calculate the precise number of shares or contracts to buy so that you risk exactly 1%. No more, no less. Just cold mathematics standing between you and the fate of our overconfident trader. Knowing risk 1% is worthless if you can't convert that abstract concept into exact share count, contract size, or lot size when real money is on the line. This is where most traders fail. They understand the theory. They nod along with the mathematics. They promise themselves they'll be disciplined. Then they open their trading platform, see a setup they like, and type in a random number of shares based on how they feel in that moment. That's not risk management. That's guessing with mathematical decoration. Amateurs estimate. They look at their account balance, glance at the chart, and think, I'll buy 500 shares. That feels about right. Professionals don't guess. They treat position sizing as an engineering problem, not an artistic choice. They calculate with surgical precision, the same way every single time, regardless of how confident they feel about any particular trade. If you cannot instantly translate your risk percentage into a concrete number of shares before you enter a trade, you are not trading professionally. You are gambling with a vague hope of safety. Here is the exact step-by-step protocol that removes all emotion from position sizing. This is the mechanical process you must internalize until it becomes as automatic as checking your entry price. Step 1. Define your total trading capital. This must be honest money, not the number you like to tell people at parties, not money you might add to your account later. The real, current balance that is dedicated exclusively to trading. More critically, this must be money you can afford to lose completely without affecting your lifestyle, your rent, your groceries, or your family's security. This distinction is crucial because trading capital must be psychologically separate from survival capital. If you're trading with rent money, you've already lost before you place your first order. Fear will control every decision. You'll exit winners early because you need the cash. You'll hold losers too long because you can't emotionally afford to realize the loss. Your brain will sabotage every edge you might have. For our working example, let's use $10,000. You've saved this amount specifically for trading over months or years. It's real money. so losses hurt enough to keep you disciplined, but losing it won't force you to change how you live or pay bills. Step 2. Calculate your maximum risk per trade. This is simple arithmetic that becomes your anchor. Take your total trading capital and multiply by 0.01. $10,000 times 0.01 equals $100. Write this number on a sticky note and attach it to your monitor. Max loss per trade, $100. This $100 is your tuition payment for each trade. It's the maximum amount you're willing to pay the market to find out whether your hypothesis is correct. Think of it as purchasing information. If the trade wins, you profit and learn. If the trade loses, you paid $100 for data that makes your next decision better. Either outcome keeps you in the game tomorrow. Step 3. Define entry price and stop loss before any order. This is non-negotiable. You cannot calculate risk if you don't know exactly where you're getting out. Your stop loss isn't just an arbitrary line on a chart. It's your invalidated hypothesis point. It's the precise price level where the market tells you that your original reason for entering the trade no longer exists. Let's say you're analyzing a stock currently trading at $50. You study the chart and determine that if price drops below $47, the uptrend structure breaks and your thesis becomes invalid. Your entry is $50. Your stop is $47. The difference is $3 per share. This is your risk per share. Every single share you purchase carries exactly $3 of potential loss. Step 4. Apply the position sizing formula. This is the only mathematical equation you need to master in trading. Position size sec. Risk per share. Maximum risk. Let's plug in our numbers. Your maximum risk is $100. Your risk per share is $3. 100 divided by 3 equals 33.33 shares. Since you cannot buy fractional shares in most markets, you round down to 33 shares. That is your position size. Not 100 shares because you feel confident. Not 10 shares because you're nervous. Exactly 33 shares, determined by mathematics. If you buy 33 shares at $50 and the stock drops to your stop at $47, you lose 33 shares times $3 per share, which equals $99. That's exactly 1% of your $10,000 account. You were wrong. You took the loss cleanly, and your account balance is $9,901. You're alive, psychologically intact, and ready for the next opportunity. Here's the crucial mindset shift that separates professionals from the struggling masses. Your position size is determined by your stop distance, not your conviction about the trade. Let's examine how this works across different scenarios with the same stock. Suppose market volatility is higher, and to avoid getting stopped out by normal price noise, you need a wider stop at $45. Now your risk per share is $5. Apply the formula. $100 divided by $5 equals 20 shares. Same account size, same 1% risk, but because the stop is wider, you buy fewer shares. Now imagine a tight consolidation pattern where you can confidently place a stop at $48. Your risk per share drops to $2. 100 divided by 2 equals 50 shares. You didn't decide to buy more shares because you liked the trade more. You bought more shares because the technical structure allowed for a tighter stop while maintaining identical dollar risk. This logic applies universally across every tradable market. In Forex, if your stop is 50 pips away and each pip is worth $1 per mini lot, your risk per mini lot is $50. With your $100 maximum risk, you can trade exactly 2 mini lots. In futures, if you're trading crude oil with a stop 30 ticks away and each tick is worth $10 per contract, your risk per contract is $300. Since your maximum risk is only $100, you cannot trade even one full contract. The mathematics protects you from over-leveraging. This creates a profound psychological transformation in how you approach markets. Instead of asking, how many shares do I want to buy? You start asking, is this setup worth spending 1% of my ammunition? That single question changes your entire relationship with trading. Suddenly, marginal setups get filtered out naturally. That borderline breakout that might work? If it requires a wide stop that limits you to tiny position size, maybe it's not worth the bullet. That clean pivot with tight risk structure? Now you can take meaningful size while still risking only 1%. You stop thinking like a gambler hoping for wins. You start thinking like a sniper choosing shots. Waiting becomes a strategic position, not a frustrating delay. You realize that not trading is often the highest return decision you can make, because it preserves your capital for truly exceptional setups. Professional traders also account for real-world execution factors that textbooks ignore. Markets don't always fill you exactly at your stop price. In volatile conditions, you might get filled a few cents worse due to slippage. Professionals build this into their calculations by slightly undersizing positions. If your math says 33 shares, you might buy 32 to leave room for execution slippage while still staying under your 1% limit. But even if you master this formula perfectly, calculate every position with precision, and never violate your 1% rule on individual trades, there's a hidden trap that can still destroy your account. It's the silent killer that catches even disciplined, risk-aware traders. Imagine you find 5 different stocks that all look exceptional. You apply the formula flawlessly to each one. Tesla at 1% risk, Nvidia at 1% risk, AMD at 1% risk, Apple at 1% risk, Microsoft at 1% risk. You feel diversified. You feel professional. You've followed every rule perfectly. But you've walked into a minefield. All 5 positions are essentially bets on the same underlying theme: technology momentum. If the Nasdaq sells off hard on macro news, all 5 positions will likely hit their stops in the same session. You didn't take 5 separate 1% risks. You took one disguised 5% bet on tech strength. When that theme reverses, you don't lose 1% 5 times over several days. You lose 5% of your account in one brutal afternoon. This is correlation risk, and it's the sophisticated trap that destroys even mathematically disciplined traders. In the next chapter, I'll show you exactly how professionals manage this hidden leverage. We'll explore how volatility creates psychological risk even when mathematical risk is controlled, how to identify when seemingly separate trades are actually correlated bets, and how to structure true portfolio diversification that protects you when entire market themes collapse overnight. Because mastering single-trade position sizing is just the foundation. Mastering portfolio-level risk is what separates the survivors from the casualties when the real storms hit. Here's where most so-called risk-aware traders still get destroyed, and it's the sophisticated trap that catches even the mathematically disciplined ones who calculate position size perfectly. They think 5 1% trades equals 5% total risk spread across different opportunities. They congratulate themselves for following the formula. They feel diversified because they hold 5 different tickers. In reality, they've often placed one disguised 5% bet on the same underlying theme, and they don't realize it until that theme collapses and takes their entire account down with it. This is correlation illusion, and it's the silent assassin that destroys traders who think they've mastered risk management. You can follow every individual position sizing rule perfectly and still blow up your account through hidden portfolio-level leverage. Picture this exact scenario that plays out in real accounts every single week. You've mastered the position sizing formula. You're risking exactly 1% per trade with mathematical precision. You scan the market and identify 4 exceptional setups. You go long Tesla at 1% risk, long Nvidia at 1% risk, long AMD at 1% risk, long QQQ, the Nasdaq itself, at 1% risk. On paper, that's 4 separate 1% risks, 4 different tickers, 4 different chart patterns. You feel professional. You feel diversified. You've spread your risk intelligently across multiple positions. Then the Federal Reserve announces an unexpected hawkish shift, or inflation data comes in hot, or geopolitical tensions spike overnight. The market gaps down hard at the opening bell. Growth stocks get hammered. Technology gets crushed. All 4 positions blow through their stops in the first 30 minutes of trading. Tesla down 8%, Nvidia down 7%, AMD down 9%, QQQ down 5%. You're watching in horror as 4 stop losses execute almost simultaneously. You didn't lose 1% 4 times over different days where you could adjust and adapt. You lost 4% of your account in one brutal morning. Why? Because you weren't holding 4 separate bets. You were holding one concentrated position on technology momentum disguised as 4 different trades. This is what professionals mean when they talk about correlation risk. When you're long Tesla, Nvidia, AMD, and QQQ, you're not betting on 4 independent events. You're making 4 bets that all depend on the same market drivers: technology sector strength, growth stock appetite, risk on sentiment, and NASDAQ momentum. These aren't separate probabilities. They're linked probabilities that rise and fall together. During normal market conditions, these stocks might move somewhat independently. Tesla might rally while Nvidia consolidates. AMD might break out while QQQ chops sideways. This creates the illusion of diversification. But during moments of market stress, and stress is when you most need diversification to work, correlations spike toward 1. Everything risky gets sold together. The tickers don't matter. The correlation dominates. It's like buying 4 different houses all in the same neighborhood and thinking you're diversified in real estate. When that neighborhood floods, all 4 properties lose value simultaneously. You needed houses in different cities, different states, different economic zones to achieve true diversification. Professionals don't fall for this trap because they don't think in terms of individual trades. They think in terms of portfolio risk. Their primary question isn't, what's my risk on this trade? But if the underlying theme I'm betting on collapses completely, what's my total exposure across all positions? Here's the professional protocol for managing this hidden leverage. Maximum total open risk. 3 to 4% cap. Regardless of how many positions you hold, cap your combined open risk at 3 to 4% of your account maximum. If you're in 4 positions, each can risk 1%. But if you want to hold 8 positions, each can only risk 0.5%. The total exposure to simultaneous loss is capped at a survivable level. This forces brutal selectivity. You can't take every decent setup anymore. You have to choose only the highest probability opportunities because your ammunition is limited by portfolio-level constraints, not just individual trade constraints. This naturally improves your trade quality because scarcity creates focus. Correlation adjustment protocol. If multiple trades depend on the same fundamental driver, reduce individual position risk to 0.5 to 0.7% each. Let's replay our technology example with this rule applied. You want exposure to Tesla, Nvidia, AMD, and QQQ. You recognize they're all driven by tech momentum. Instead of risking 1% on each, you risk 0.6% on each. Now if all 4 hit stops simultaneously, you lose 2.4% instead of 4%. Still painful, but survivable. More importantly, you're acknowledging the correlation explicitly in your risk structure rather than pretending it doesn't exist. Theme diversification. Uncorrelated exposures. Professionals deliberately spread risk across market themes that don't move in lockstep. Maybe you're long energy stocks, short treasury bonds, and long defensive consumer staples simultaneously. If technology sells off, your energy position isn't automatically affected. If rates spike and bonds fall, your defensive stocks might actually benefit from flight to safety flows. This doesn't guarantee you'll never have multiple positions lose on the same day. Sometimes everything sells off together, but you've dramatically reduced the probability of total portfolio catastrophe compared to stacking all your bets on one theme. The second hidden killer that destroys even correlation-aware traders is volatility mismatch. And this is where mathematical risk diverges from psychological risk in dangerous ways. 2 trades can both risk exactly 1% mathematically, but carry vastly different emotional costs. Imagine you're long a quiet utility stock that moves 0.5% per day with a tight stop. Compare that to being long a volatile meme stock that swings 5% intraday. Both positions might risk $100 if stopped out. Both are mathematically 1% of your account, but they are not psychologically equivalent. The utility stock sits there calmly. You check it once a day. Price drifts slowly toward your target. Your sleep is undisturbed. Your focus remains clear for other decisions. The meme stock is psychological warfare. You check it every 10 minutes. It spikes 2% in your favor, and euphoria floods your system. Then it reverses 3% against you, and panic takes over. It's not even close to your stop, but the violent intraday swings are triggering fight or flight responses. You can't focus on anything else. You're glued to the screen. Here's the brutal truth. Risk isn't just mathematical, it's psychological. If your positions are so volatile that you cannot sleep, that you're constantly checking prices, that every swing triggers emotional reactions, you will sabotage your own system. You'll move stops to avoid the pain of taking losses. You'll cut winners early to escape the emotional roller coaster. You'll revenge trade after volatile losses, because you're operating from desperation rather than disciplined probability assessment. The mathematical edge becomes worthless when your emotional capital is depleted. Professionals understand this. They match position size to both mathematical risk and emotional tolerance. They'd rather trade smaller size in highly volatile names or avoid them entirely, even if the mathematical risk is identical to calmer positions. Here's the advanced protocol that incorporates both correlation and volatility management. For high volatility names, risk 0.5 to 0.7% instead of the full 1%. The violent swings won't trigger emotional overrides of your system. For correlated positions, divide your normal risk by the number of similar themes. 3 tech positions get 0.33% each, not 1% each. For overnight holds in gapping markets, reduce size to account for gap risk. Markets can gap past your stop on earnings or macro news. Size down to 0.7% or less to absorb potential slippage. For illiquid names, cut size further, because stops might not fill at intended prices. Thin trading can cause significant slippage against you. This isn't about being conservative or scared. This is about being precise. It's about acknowledging that real trading involves factors beyond simple mathematics: correlation, volatility, psychology, execution risk, and gap risk. Professionals don't ignore these factors. They price them into their position sizing explicitly. When you implement these portfolio-level protocols, something remarkable happens. Your drawdowns become smaller and more manageable. Your psychology remains stable through rough patches. You stop experiencing account-threatening disasters. But here's what nobody tells you. This defensive foundation actually accelerates wealth building through a compounding mechanism that most traders never discover. The same mathematics that protects you on the downside becomes an exponential growth engine on the upside once you start winning consistently. In the next chapter, I'll show you exactly how the 1% rule automatically scales your position size as your account grows, creating compound growth without you ever having to make emotional decisions about betting bigger. You'll see how true defense transforms into aggressive offense through the power of mathematical compounding. Here's the counterintuitive truth that separates professionals from perpetual strugglers, and it's the reason why legendary traders like Jesse Livermore became obsessed with position sizing above all else. The 1% risk rule isn't just defensive armor protecting you from catastrophic losses. It's actually the foundation for explosive offensive growth. Once you start winning consistently, the exact same mathematics that protected you on the downside now accelerates you on the upside through a compounding engine that most traders never experience because they blow up before it kicks in. The amateurs see the 1% rule as a speed limit. Professionals see it as a turbocharger. Let's trace this through a concrete mathematical example so you can see exactly how the mechanics work in real time. You start with $10,000 in trading capital. Following the 1% rule religiously, your maximum risk per trade equals $100. You've developed a system with a genuine edge, a 55% win rate with 2-to-1 reward to risk ratio. Nothing miraculous, just disciplined execution of proven setups. You hit a solid winning streak. 5 consecutive winners, each returning $2 for every $1 risked. Let's walk through the precise mathematics. Trade 1, risk. $100, make. $200, account balance. $10,200, trade 2, risk. $102, 1% of new balance, make. $204, account balance. $10,404, trade 3, risk. $104, make. $208, account balance. $10,612, trade 4, risk. $106, make. $212, account balance. $10,024, trade 5, risk. $108, make. $216, account balance. $11,040, Your account has grown by approximately 10% in 5 trades. Good, but here's where the magic reveals itself. Your 1% risk is now $110. Look at what just happened automatically, without any emotional decision making on your part. You're risking $10 more per trade, but you're still at exactly 1% of your total capital. The system forced you to scale up your position size in direct proportion to your success. This is the compounding engine at work. Your risk grows proportionally with your account, which means your position sizes grow, which means your absolute dollar profits grow, which means your account accelerates faster, which means your next position is even larger. It's a self-reinforcing mathematical cycle that builds wealth without ever increasing your percentage risk. Now contrast this with the trader who uses fixed dollar amounts, the approach that quietly destroys long-term wealth building. He starts with the same $10,000, but decides to risk $500 per trade because it feels right. That's 5% risk initially. After the same 5 winning trades, his account grows to approximately $12,500. He made more absolute profit in the short term because he was more aggressive. But here's the insidious trap. He's still risking $500 per trade. That $500 is now just 4% of his $12,500 account. He's accidentally becoming more conservative precisely when he should be pressing his advantage. If his account doubles to $20,000, he's still risking $500 per trade, now just 2.5%. His position size isn't scaling with his success. He's driving a Ferrari, but taking his foot off the accelerator the faster he goes. The mathematics work against his wealth building. The 1% rule does the exact opposite. It maintains proportional aggression relative to your success while preserving identical survival margins. When your account reaches $20,000, you're automatically risking $200 per trade. When it hits $50,000, you're risking $500. When it reaches $100,000, you're risking $1,000 per trade. You never made an emotional decision to increase size. The mathematics did it for you. This connects directly to what Jesse Livermore called pyramiding on a proven position. Livermore never bought his full line at once. He'd test the waters with a small position, wait for the market to confirm his thesis, then add more size as the trend developed. But here's the critical insight. You can't pyramid if you've already blown up your base. The 1% rule ensures you always have capital to build upon. Now let's explore the advanced technique that amplifies this effect exponentially. Once a position moves in your favor and reaches a logical technical level, you move your stop loss to your entry price, break even. The moment you do this, something remarkable happens in your risk accounting. You now have 0 risk on that trade. Think about the implications. You entered risking 1% of your account. The trade moved favorably. You moved your stop to break even. Your risk dropped to 0. That 1% of risk budget you allocated to this trade is now freed up for a new position. You can immediately enter another trade at 1% risk while still holding your original position. If that second trade also moves in your favor and you move its stop to break even, you've freed up another 1%. You might end up with 3 or 4 positions riding a major trend, each with stops at break even or better. Mathematically, it looks like this. Total market exposure while account risk 0. You're capturing maximum profit potential from extended trends while maintaining minimal downside exposure. You might have 3 times your normal market exposure, but your actual account risk remains at 1% or even 0. This is asymmetric risk-reward at the portfolio level, the professional's dream scenario. This is how small accounts become large accounts. Not through reckless, all-in bets on single trades. Not through hoping one lottery ticket hits. Through systematic compounding of proven edges, automatic position scaling tied to success, and intelligent risk recycling as positions move in your favor. But here's the uncompromising caveat that prevents this from being a fantasy. This compounding engine only works if you have a genuine statistical edge. The 1% rule is an amplifier, not a creator. It amplifies whatever advantage you bring to the market. If you have no edge, if your system produces random results with no positive expectancy, perfect position sizing won't make you profitable. You'll just lose 1% at a time instead of 10% at a time. You'll survive longer, which gives you time to develop an edge, but the rule itself won't create profits from thin air. However, if you have even a slight statistical advantage, that 55% win rate with 2-to-1 reward risk we used in our example, the 1% rule transforms that modest edge into exponential growth over time. Let's run the mathematics on this system over 100 trades, with 55 winners making $200 each and 45 losers losing $100 each. You'd expect $11,000 in wins minus $4,500 in losses, for net gains of $6,500 on your original $10,000 account. But that's just linear calculation. Because your position sizes were growing throughout those 100 trades as your account compounded, your actual returns are significantly higher. The compounding effect accelerates your growth beyond simple projections. This is why professionals focus obsessively on two things: developing a genuine edge and protecting that edge through disciplined risk management. The edge creates the raw material for wealth. The risk management allows the compounding engine to run long enough to transform modest advantages into life-changing returns. Most traders spend 90% of their energy hunting for better indicators and perfect entries, and almost no energy on the position sizing that determines whether they'll still be trading in 5 years. They have it backwards. Your edge doesn't need to be spectacular. It just needs to be real and consistently executable. When you stop trying to get rich in a week, you unlock the ability to get rich systematically over time. And usually, when you detach from the need for speed, the results come faster than expected, because you stop sabotaging the process with emotional errors driven by impatience. In our final chapter, we'll synthesize everything into one systematic daily ritual. I'll show you the exact step-by-step process professionals use every morning to make discipline automatic, to remove emotion from risk decisions, and to create a trading structure where blowing up becomes mathematically impossible. This isn't theory anymore. This is the operational protocol that stands between you and becoming another cautionary tale about the trader who had a great system but destroyed himself through poor risk management. Let's close the loop. Remember the trader from Chapter 1 who bled out through repeated position sizing violations, the one who justified each oversized bet with conviction, saying this setup is different. I'm sure about this one as he pushed more and more of his account onto each new trade. He didn't fail because he couldn't read a chart or identify good setups. He failed because he never built the systematic foundation that makes discipline automatic rather than discretionary. He wanted the penthouse before pouring the concrete. The 1% risk rule is that concrete foundation. It's not glamorous. It won't impress anyone at a cocktail party. You can't screenshot discipline and post it on social media. But this unsexy systematic approach is the difference between trading professionally in 5 years versus becoming another I used to trade story in 5 months. The gap between knowing this rule and living it every single day is where most traders fall into the void. They understand the mathematics. They agree with the logic. They promise themselves they'll follow it religiously. Then the market opens, emotions flood the system, and discipline evaporates like morning mist. They make position sizing decisions based on how they feel about each setup, not on mathematical reality. Professionals don't rely on willpower. They don't sit down each morning hoping they'll be disciplined this time. They build systematic rituals that remove emotion from risk decisions entirely. The moment you make risk management contingent on how you feel that day, you're already drifting back toward amateur territory. Here's the exact daily protocol that transforms the 1% rule from abstract concept into operational reality. Pre-market protocol. Foundation setting. Before you look at a single chart, before you scan for any setup, before you check overnight news, you establish your risk parameters for the day. This happens every morning without exception, the same way a surgeon scrubs in before every operation regardless of how routine the procedure appears. First, calculate your current account size and your exact 1% risk amount. Write it down physically, or type it where you can see it constantly throughout the trading session. Today's maximum loss per trade, $113 if your account is $11,300. This isn't just information, it's your boundary, your anchor to mathematical reality before the market's psychological warfare begins. Second, set your total portfolio risk limit. State explicitly, maximum combined open risk, 3-4% of my account. If you're holding 3 positions at 1% each, You cannot enter a fourth position without closing something first, or reducing size on new entries to 0.5%. This portfolio-level constraint prevents correlation disasters where seemingly separate trades all collapse together. Third, review your current correlation exposure by asking, explicitly, am I betting too heavily on one theme? If you're already long two technology stocks and the Nasdaq ETF, you're not diversified. You're concentrated on tech momentum. If you're long crude oil, energy stocks, and short treasury bonds, you're betting on inflation expectations. Acknowledge these concentrations explicitly and adjust accordingly. Fourth, check your emotional state and recent performance. Are you coming off a big winner that might make you overconfident? Are you recovering from losses that might make you desperate? Professional traders monitor their psychological capital as carefully as their financial capital, because depleted emotional resources lead to rule violations. This pre-market ritual takes 5 minutes. Those 5 minutes eliminate 90% of the emotional risk decisions that destroy accounts during live trading hours. Trade selection filter, the ammunition question. As you scan through potential setups during the trading day, you need a single filter question that eliminates marginal trades and transforms waiting from frustrating inaction into strategic positioning. That question is this pattern strong enough to spend 1% of my limited ammunition? This psychological reframe changes everything. You're not just asking whether the trade might work, you're asking whether it's worth the cost of one bullet from your finite magazine. You only get so many bullets per day, per week, per month, based on your portfolio risk limits and correlation constraints. Think like a sniper with 5 bullets, not a machine gunner spraying into the darkness. When you view risk as a scarce resource, marginal setups get filtered out naturally. That stock, that's sort of breaking out but not really, not worth the bullet. That pattern that might work but requires a wide stop that limits your position size to 10 shares, not worth the ammunition. You become selective not through forced discipline, but through resource scarcity. Scarcity creates focus. Focus improves execution quality. You stop overtrading because you literally cannot afford to waste shots on mediocre opportunities. Execution protocol. Mechanical precision. When you've identified a setup that earns your ammunition, you execute with mechanical precision following an invariable sequence that removes all emotional override mechanisms. First, define your entry price, stop loss, and profit target before placing any order. Write these numbers down. Your stop loss isn't negotiable, it's the precise price where your original thesis becomes invalid. If you cannot define where you're wrong, you cannot take the trade, period. Second, calculate exact position size using the formula. Position size self, stop distance, risk amount. If your maximum risk is $113 and your stop is $3 away from your entry, you buy exactly 37 shares, not 35 because you're nervous, not 40 because you're confident. Exactly 37 shares, determined by mathematics. Third, evaluate whether the required stop distance keeps you within your 1% limit. If the technical structure demands a stop so wide that you'd need to risk more than 1% to take a meaningful position, you have exactly 2 choices: trade smaller size and accept minimal profit potential, or skip the trade entirely. There is no third option where you violate the rule because the setup looks exceptional. If the math says you can only buy 15 shares and that makes the trade unattractive due to small profit potential, that's the formula protecting you from poor risk-reward opportunities. Accept the protection. Live management. 3 non-negotiable rules. Once you're in a trade, 3 rules govern your behavior with 0 exceptions, regardless of how the position moves or how you feel about it. Rule 1. Never move stops further away to avoid taking a loss. Your original stop was your invalidation point based on technical analysis when your thinking was clear. If you move it wider, you're no longer trading a system, you're hoping and praying. The moment you feel tempted to widen a stop, that's confirmation you should take the loss immediately. Hope is not a risk management strategy. Rule 2. Consider moving stops to break even on profitable positions to free up risk budget. Once a trade moves favorably and reaches a logical technical level, a prior resistance point, a key pivot, a meaningful percentage gain, you can move your stop to your entry price. This transforms a 1% risk position into a zero risk position, freeing up that ammunition for a new opportunity while keeping you in the original trend. Rule 3. Exit at your predetermined stop without hesitation, negotiation, or hope. The market doesn't care about your feelings. It doesn't care that you need this trade to work. It doesn't care that you promised yourself you'd make back yesterday's loss. When your stop is hit, you execute the exit like a surgeon. Clean cut. No hesitation. No bargaining. Post-market review. The learning loop. Every evening, before you close your trading platform, you perform a process review that focuses on execution rather than outcome. You ask 3 specific questions that determine your long-term survival probability. Question 1. Did I respect the 1% rule on every single trade today? If the answer is no, you failed, regardless of how much money you made. A profitable trade that violated your risk rules is dangerous success. It rewards bad behavior and makes future violations more likely. Question 2. Did I exceed my portfolio risk limit? Did you stack too many correlated positions? Did you ignore the 3-4% total risk cap? Did you rationalize taking a 5th position because the setups looked different even though they were all betting on the same theme? Question 3. Where did fear or greed attempt to override my system? Even if you didn't violate the rules, identify the moments where you felt the pull to do so. Where did you hesitate on a good setup? Where did you feel the urge to chase? Where did you want to revenge trade after a loss? Bringing these subconscious impulses into conscious awareness reduces their power over future decisions. Write down your answers. This isn't self-criticism, it's pattern recognition. Over weeks and months, you'll start seeing the same emotional triggers repeating. Once you see them clearly, you can design specific rules to neutralize them before they cause damage. The core maxim. Here's the principle to carry forward into every trading session. You don't control the market. You only control your downside. You cannot force the market to give you winning trades. You cannot predict with certainty which setups will work. You cannot eliminate losing streaks or prevent drawdowns. But you can control exactly how much you lose when you're wrong. That control, that single variable in an otherwise chaotic equation, is your edge over 90% of market participants who are gambling with undefined risk. If you implement this daily ritual around the 1% risk rule, you cannot blow an account. Let me be mathematically precise about this claim. Catastrophic account destruction becomes impossible. You may have drawdowns. You may experience cold streaks where nothing works for weeks. You may watch your account drift lower temporarily. But you will never face the devastating losses that end trading careers. You've built a floor beneath your feet that you cannot fall through. Even if you hit 20 consecutive losses, a statistical near impossibility, you'd still retain approximately 82% of your capital. You'd be wounded but not destroyed, able to continue executing your system while others are explaining to their families how the money disappeared. From that foundation of mathematical safety, trading becomes what it was always meant to be, a probability game governed by your edge and time. You don't need to be right 80% of the time. You don't need home run trades. You just need a slight statistical advantage executed with perfect risk discipline, and time will compound that edge into substantial wealth. Cut losses fast, because they're small and painless. Size positions small because you know the mathematics work in your favor over time. Wait patiently for your pivotal points, because you respect your ammunition. Let discipline and mathematics do the heavy lifting that hope and conviction never could accomplish. You are no longer a gambler hoping for lucky breaks. You are a professional executing a systematic business plan where the worst-case scenario is manageable and the best-case scenario is unlimited. Now that you've bulletproofed your defense through systematic risk management, you're ready to focus on offense. You're ready to learn exactly where to deploy this carefully protected capital for maximum gain. In the next lesson, we'll dive deeper into reading those pivotal points, the specific technical setups and tape behaviors that truly earn the right to risk your precious ammunition. We'll show you how to identify the precise moments where probability shifts dramatically in your favor, so you can strike with confidence knowing your downside is already handled through unbreakable mathematical discipline.